Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. Scarlett Fu, it's been an ugly September so far.
But it's still early. This is just the second trading day and things are improving.
That's true. Time does march on and today's a little bit better than yesterday. Let's get to the biggest stories right now in the more than $13 trillion global ETF industry. Treasury yields tumbling, briefly disinverting the yield curve after data shows that a cooling labor market is really increasing bets on steep Fed cuts.
Plus, there's another big name investor going into ETFs. We speak to Rob Arnott of Research Affiliates on the new fund giving some love to index rejects.
We will also discuss mortgage-backed securities ETFs with Harley Bassman. He, of course, is the creator of the MOVE Index, now a managing partner at Simplify Asset Management. So a lot coming up here, but as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. Not a lot of good news if you're an equity bull. Equity ETFs largely have taken in no money in the past week. You can see here at the top, it's a bunch of bond ETFs. It's not a great sign. You know, we'll see. It's only 1 week. Equities have been gangbusters all year, basically. Potentially also people wanting to play Fed cuts with the bond purchases there, both LQD and TLT. VU continuing its Pac-Man-esque haul of cash. It's at $61 billion year to date. That's $11 billion over the annual record, and it's only barely September. Amazing. Let's look at the outflows here. You have QQQ at the top with $3 billion. That's a lot. So again, and DIA, those are trader ETFs. People a little spooked, getting out of the market, rebalancing. We'll see what that's a momentum ETF there. Speaking of momentum, speaking of smart beta, we have the godfather of smart beta on the show today. So I wanted to just look at the state of smart beta ETFs. We don't talk about smart beta that much anymore, but it was like the hot controversial topic about 10 years ago. But this space is quietly hoovering up assets. You look here, it's now at $2 trillion, right? That's about 23% of all ETFs. And you can see the categories. There's traditional style box like growth and value. Then there's some more newfangled stuff like low volatility, momentum, quality. These are ways to play the market the way an active manager might using factors. And it's a very popular area and it's very cheap. So it's almost like new active, but for lower fees and rules based. So it's interesting to see. We're seeing a rotation a little bit into value. And again, this can tell us a lot about what investors are looking at. But again, Katie, $2 trillion, big milestone for smart beta.
All right, Eric, thank you. And joining our conversation now is the godfather of smart beta. His name is Rob Arnott. He is chairman and founder of Research Affiliates. Joining us on set, it's great to see you again.
Good to see you again.
So let's talk about the news in the ETF world this week, and that is Research Affiliates filing for the Research Affiliates Deletions ETF. This is exciting because, of course, you license out your indexes, but this is your first official ETF. Why this one for number one?
Well, firstly, we've partnered with many major asset management firms. When it comes to a niche area, often the majors will embrace an idea after it's had a proven track record. And this is just a really neat niche idea that we wanted to bring to market. So I had to wait 70 years to partner with ETF architects to launch an ETF based on deletions. What could be better than buying the rejects?
Well, I've kind of been thinking about it. So, of course, the rationale here is that you'll buy companies that were recently deleted from major indexes. I've kind of been thinking about it in the same sort of brushstrokes as a fallen angels credit ETF, just in the equity world. Why does that make sense? What about it makes that actually a profitable investment to make?
We wrote a paper back in 2018, buying high and selling low with index funds. And we pointed out that while index funds are really boring, the way they decide what stocks to add and what stocks to drop is not at all boring. The stocks that are added are frothy, beloved companies on a surge, performing brilliantly, trading at lofty multiples. Some of these go on to be the next Tesla or NVIDIA. Others turn out to be bits of frothy popularity that just don't deliver the goods. And so there's a lot of rotation, a lot of flip-flops. On the flip side, those replace stocks that are deeply out of favor, that are fallen angels, that have been crushed in the marketplace, typically down over 50% in the last year before they're dropped. And those companies tend to be liquidated from the index at less than half the market multiple. Well, if you buy the deeply out of favor, unloved companies, what you find is that they outperform the market by about 5% per annum compounded over the last 30 years. Well, that's enough to make 71 times your money in 33 years. That's not bad. And so we've been playing this in our own portfolios for a while now, and we decided, why don't we make this available? This is going to be fun. It'll be a completion strategy. I was just talking with Dave Nadig, and he made the observation that what you're really doing is creating a smart completion strategy that picks up on companies that aren't in the indexes anymore. Therefore, you're completing the package, but you're excluding companies that are likely value traps, and you're focusing on the ones that are recently, newly out of favor, unloved, and deeply cheap.
How long does this outperformance that you cited last for? How long do you intend to hold on to these rejects before you then cycle out of them?
We find that over the first 5 years, they tend to beat the market by 5% a year. After that, they tend to continue to beat the market by diminishing amounts. Now, there's a liquidity issue. Let's suppose you want to buy stocks that drop out of the top 500. That's going to be 20 stocks in any given year. Not a lot of diversification. These are thin, illiquid stocks. There's a capacity issue. If you hold it for 5 years and you take the stocks that drop out of the top 500 or out of the top 1,000, those stocks, now you're looking at a portfolio of 150 names, even after you filter out the ones that are really, really deep quality issues.
So 5 years and then they get the boot, essentially?
They get the boot after 5 years, or if they re-enter the index.
So this strategy, you know, when a stock gets a higher weighting in an index or enters the S&P, it's because active loves it. They're buying it, making the market cap go up, and then the S&P is like, okay, it's big enough to come into our index. And then if it goes out of the index, it's because active is dumping it, right, and shrinking its market cap. So if you're buying these deletions, aren't you buying the stuff active hates? And do they hate it for a reason?
They always hate it for a reason. And some of these companies go on to achieve great failure.
Great failure.
But all they have to do is exceed bleak expectations to rebound handily. The index, if you go back historically, wins just about half the time. But when it loses in any given year, it lags by 5%. And when it wins in any given year, it wins by about 18%. I love asymmetries. Investment management success is predicated on asymmetries, and that's a biggie.
And let me ask you about small caps, because talk about an unloved space, just in general. I suppose you're trying to get them when they're mid caps before they get even more rejected into small cap land.
A lot of these are small cap by the time they're...
But do small caps, are they ever going to really take over and sort of run the market for an extended period of time? It seems to be all head fakes for the past 15 years.
Oh, I think it's all head fakes for the last 40 years. If you looked at the Fama French value factor, small cap versus large, not value factor, size factor, small cap versus large cap, it peaked in 1983. It's never achieved that peak since. But when it rebounds, it can rebound enormously. And when it is, most ETFs are launched when they're in a space that's frothy and popular. That's the way to make sales. If you launch an ETF in an area that is deeply out of favor, unloved, and dirt cheap, it may not catch attention, but the possibility of it having a stupendous first 10 years is tremendous. So I love the idea, as a lifelong contrarian, I love the idea of introducing a strategy when it's at near record cheapness.
Rob, I loved what Katie said about fallen angels and how this is the equity equivalent of fallen angels. Are you kind of surprised that there wasn't something like this made already, given that it's a fairly straightforward concept?
A lot of our ideas, I'm endlessly surprised, are ones that haven't been tapped. This is one that we could just as easily have launched 20 years ago or 30 years ago. A lot of research went into it, but the research wasn't so much, does this idea work? We knew it would work. It's how do we make this scalable? And the way to make it scalable is to bring the turnover down, to bring the number of companies up, and the way to do that is to have buy when they fall out of the top 500, buy when they fall out of the top 1,000, and buy them in a large enough number, holding it long enough that your turnover is nice and low.
So that's interesting, and just to sort of crystallize that point, so you could have launched it 20 years ago, but is it safe to say that the reason you're launching it now is because you've solved for some of those problems, how to make it scalable?
We have solved for all of those problems, and so it is scalable. It has large capacity. You got 150 names, a lot of them are thinly traded, small, but if you've got 150 names and you put 10 million in each of them, that's $1.5 billion right there. So that becomes very easy.
And that is so interesting because we talk to a lot of first-time issuers on this show, and the show is called ETF IQ, so we view the world through a very ETF lens, but it's really interesting to hear that perspective about what finally brought you to the table.
I also find it interesting that it's an index. Everything's active now, it seems like, even themes and smart beta. We talked earlier about when you index something, you're creating a robot. Mm-hmm. It does what you program it to do, and it removes emotion.
Exactly.
You find that
right.
to be a positive, yet a lot of ETFs coming out are active, which are going to have wiggle room and emotion baked in them. Is that why you did that?
I've always believed in stripping emotion out of the decision process.
Still working on that one.
I think we all are. How do you see this ETF fitting into someone's portfolio? Is it kind of an overlay onto the most basic index fund, or?
Well, firstly, it's not available today. Mark your calendar. It's available Tuesday.
When it comes out?
So if you mark your calendar and take a look, that's when it's possible to trade it. But be that as it may, the way to fit this into the portfolio is if you like the idea of buying rejects, buying what's unloved. Great, this is the vehicle for that. If you like the idea of a completion strategy that fills in what the index funds that you own don't have, that's a role for it. If you like deep value and you like small cap because they're both severely out of favor, as a replacement for Russell 2000 value, this is a wonderful way to play small cap value in a fashion that leaves out most of the likely value traps and has a chance to participate in outsized returns.
Rob, 30 seconds, there's a producer in my ear, but is this a one-off or should we be on the lookout for more research affiliate ETFs?
Oh, we're always working on interesting ideas.
Okay.
So we can talk again in a few months.
Okay, so watch this space. Rob, so enjoyed this. Really great to see you in person. That, of course, is Rob Arnott of Research Affiliates. Now coming up, no summer slump in the booming world of ETFs as inflows on pace to approach the 2021 record. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with what could be another record for ETF inflows this year. You take a look at what the funds have taken in year to date, over $600 billion. A lot of that coming in the last couple months. You compare that to what we've seen over the past couple years. 2021 was the record, of course, over $900 billion coming into U.S. ETFs, but we are well on our way here. It could be a dead heat, so we'll continue to keep an eye on that over the next coming months. Let's also talk about EM, though. I thought this was interesting. You take a look at BlackRock's EM fund, the ticker EEM. Actually, August was not a great month, losing $1.5 billion. That is the biggest monthly outflow since October, so clearly appetite cooling there a bit. But let's also talk about single stock ETFs. Of course, it's something we talk about often on this show, and we decided to crunch some numbers and see how long these funds are actually held for, and the results super interesting. You take a look at NVDL. This, of course, is leveraged NVIDIA exposure. Turns out it takes less than 3 days for all of its shares, the entirety of its shares, to flip. Just a couple of days there. So The good news, Scarlett, is that it looks like traders are using these as intended, because if you hold them for longer than a couple days, that's where you can run into trouble.
Right. The math does not work in your favor in those instances. What's the argument for why these single stock ETFs, particularly the leveraged single stock ETFs, are a good thing, that they serve a purpose beyond as a vehicle for speculation?
Well, it's easy to fall into arguments about free markets and who should control what we want to buy, but the point is out there is that people love to trade. There's clearly a class of traders, an engaged audience that have found these ETFs, and if used properly, I mean, you can have a lot of fun and you can certainly make a lot of money, but of course, that comes with a lot of risks as well.
Right. And the issuers do make money on this as well, because the fees are much higher than standard ETFs, aren't they?
Oh, yeah. I mean, you take a look at NVDL, for example. The fee on that one is 1.15%. You don't often see a fee over 1%.
Exactly, especially for ETFs that have come down to 10 basis points at most, right? All right, still ahead, we're going to drill down into mortgage-backed securities, the ETFs, with Harley Bassman of Simplify Asset Management. And a reminder, you can listen to Eric and Joel Weber on Trillions, their podcast that covers the entire industry. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we are looking at MTBA, the Simplify MBS ETF. This is a new ETF on the market, relatively new, within a year old. It's actively managed. And what they're trying to do here, the idea is to buy newly issued MBS. As opposed to, which has a higher rate right now, right? Because rates were recently raised. So the idea is to get more yield out of your MBS. And it's got $1.2 billion. That is a lot for a new kid on the block. And it's actually Simplify's biggest ETF, and they have some big ones. But look at the fee. To get that kind of hustle and active for 15 bips is really low. You're going to see that's the cheapest active mortgage bond ETF on the market. Let's look at the yield on this. This is where people are going to probably be more attracted to this versus, say, MBB, which is the iShares. You see the yield on here, 4.36 is the yield 12-month, and then 5.83 the indicated yield. That's going to be a little higher than the standard MBB. Now let's look at this performance versus MBB. I also threw in a short-term one because MTBA's duration is going to be about 3 years. MBB is 6 years, so it's got shorter duration. JPLD is also a short duration mortgage-backed bond fund. So you see, it's going to be a little lower than MBB, but look at the yield. So you're getting most of that price return is from that yield versus MBB only a little bit. So again, Katie, interesting novel product as usual from a company that's put out a ton of them, this one on the mortgage-backed security market.
All right, Eric, I'll pick it up from here. Joining us now to talk about this ETF is Harley Bassman. He is managing partner at Simplify Asset Management. Harley, great to see you here. Thank you for joining us.
Thank you.
And you're making this product, this asset class, essentially available to retail investors because they don't have a way of accessing these mortgage-backed securities that are issued by the government-sponsored entities, the way that institutional investors do.
Exactly. At Simplify, generally what we try to do is offer professional products to retail, what I call civilians. And this is one of them. It is very hard, almost impossible for ordinary people to buy mortgage-backed securities. And this one is special because it only buys the newly issued mortgage securities as opposed to the legacy. So if you look at the index, it might have a coupon of like 3.25, 3.5, whereas this has a coupon of about 5.5.
Well, can we meditate on the difference between normal MBS and newly issued MBS? Because it's a distinction that people probably don't often think about in their daily life. What is the difference? Why does it matter for the end investor, newly issued versus regular?
In general, it's the coupon. We had a period of QE where most of the housing market refinanced. I mean, almost 70% of all mortgage securities are 2% to 3.5%. These bonds are never going to refinance because they're out of the money, but they have very low coupons and very long durations. MTBA has a duration maybe 3.25, and a 200 basis point higher coupon. So it's a great yield vehicle. If you think rates are going to drop tremendously tomorrow, I wouldn't call it the best trade in the world. But I mean, also buying the mortgage index is problematic too, because those bonds are callable. So their performance will slow down as rates go down. So it's good for a stable kind of up and down 50, 100 market.
I find it amazing that the top holder is a pension fund, Michigan, right? And your TUA, which is another ETF you have, one of the top holders is the New York pension fund. It is so hard for new ETFs, especially, to get institutional interest. Normally, they only use the big liquid ones for operational purposes. How do you get an institution in an ETF like this when they can get anything they want for almost free?
It's very hard to buy mortgage bonds in general, even for professionals to do. And we actually have some hedge funds that will buy this, because for 15 cents, it's cheaper for me to go and do the machinations than for them to go hire someone to maneuver the mortgage bonds and manage the principal and the interest and everything else. It's kind of shocking, but I mean, the way we operate, we're not buying the actual mortgage securities, we're buying mortgage forwards, mortgage TBAs. So it's basically like a futures contract, and every month we roll them. And the idea is that we're going to go and keep the average price of this portfolio between 97 and 101. And those tend to be the best mortgage bonds to own. They have the highest yield relative to their risk. So that's the plan, and it's been working very well so far.
You said this might not be the best deal if you believe interest rates are going to fall tomorrow. They're not going to fall tomorrow, but they might fall, or they might go down in mid-September and then again in November and December. So what is the outlook for these kinds of products when the Fed is on a rate cutting cycle? When you're talking about the Fed bringing the front end, bringing their rate down, fine, I can live with that. But if you look historically, there's a shape to the curve. And if we bring the funds rate, if we get inflation of 2, funds rate will probably be 2.5, which is what they've indicated as their long-term number. That puts the 2-year note at probably 3%. That's the usual spread. Funds to 2s is going to be 50. And then that's 100 basis points from 2s to 10. So I think the back end of the curve has already made its move. And if the front end comes down and the back end kind of holds here, you're going to see the current coupon, newly issued mortgage bonds perform much better than the older mortgage bonds.
Well, Harley, great conversation. Great to have you on set with us. Have to have you back soon. That, of course, is Harley Bassman of Simplify Asset Management. And a programming note, we'll be back on Monday at our usual time next week. I know we like to occasionally have this on Wednesdays, but we're back on Monday next week, 12 p.m. Eastern Time. And you can read about this drill down segment, plus all the latest and greatest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/newsletters. I hope you can find it there. But anyway, that does it for Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. This is Bloomberg.